three and a half or so modules in preparation for your final exam. But that's down the road. You have all the material that you need for the midterm. I'll send the other materials somewhere within the next week for you so that you can have it available for those nights when you cannot sleep. You'll get up and read this crazy stuff. How about that? All right, let's see who's in the room. Eureka.
I'm here.
Okay, there you are.
It's
Eureka.
Erica. Don't forget it.
All right, Erica. Yes, I have to put the old-fashioned Erica in my mind. I'm not used to saying the new Erica. Hmm. Oh, I see what happened. Erica, can you hear me?
Yeah. Yes, I can.
Tell me if I'm right. That name on the screen should actually be E.N. Curtis, meaning Erica N. Curtis?
Yes.
Okay, okay. You will not believe, well, let me not go there before I find out. How do you spell your Erica, Erica?
Eruaka.
Oh, so this is the correct spelling.
Mm-hmm.
That's the first time I've seen Erica spelled that way. It's very
Yeah,
unusual.
it's the only one in the world.
Absolutely, absolutely. All right. So now you are unique in two ways: your fingerprint and that Erica thing. Well done.
Yes.
Right. Welcome aboard. Tanika.
I'm here.
Okay, there you are. Tanika. Okay. Chantel.
Present.
There you go. Okay. Welcome aboard, Chantel. We're in our second week already. How time flies. Feels like we were just here a minute ago. Nigel. Nigel. I guess Nigel has run off to get a cup of coffee. So we'll come back to Nigel. Juliet.
I'm here.
Hi, Juliet.
Hi.
Back. Philip.
I'm here.
Hi, Philip. You made it.
Well, I was always here.
I know.
My Wi-Fi my Wi-Fi little poor tonight, but I here.
Oh.
Yeah,
Still,
using my phone.
oh, you're using your phone. Okay.
Yeah.
Okay, not a problem. I can hear you very well.
All right.
So that's good stuff. Enrique.
I'm here, but I have to step out until Shanika Jackson will have to bring me up to speed. She can work it out for me.
Tanika? Okay. Well, if you guys have worked it out, it's called networking, and that's fine. At least you made it in the room. I'm sure she'll give you all the details. All right, Nigel, are you there yet? Hell no, I'm not here yet. Okay. So, did anybody have any issues in the last week that were credit related that you would like to share with your colleagues? Like an interesting experience, something about credit that came up that intrigued you, something that got on your nerve, pissed you off, anything like that? Man, are credit people that boring? Nothing, just a regular week of lending and collecting? Hmm. Okie dokie. Does everybody have a copy of the case study?
the case study. You sent that out?
Did I? I'm waiting to see what your colleagues will say, Juliet. You're the only one who's responded so far.
I printed the papers that you sent, in the email,
Right?
but I didn't read through it yet. But I do have a question.
Yes,
Say, for example, you have a credit application
yes,
and you have a client where their total debt service ratio is a little above 45%. It's like at 47%.
right.
And the loan to value is, let's say, 83%.
Okay.
With that being said, would you consider that to be a fair application, or would you consider that to be risky?
You know, Tamika, you've hit the nail right on the head. That's exactly the kind of question I was hoping somebody would raise. Something real, something practical, so we could bring this discussion on credit and collections alive. My answer, the simple answer, it's not too risky. And I say that reservedly. Here's what I mean. If you have a situation like that where it's slightly above the policy requirement, let me put it that way, okay, the credit policy requirement, which these days apparently for some institutions, or maybe most of them, is 45% debt, total debt service ratio. That's the first issue. Is it above 45? In this case, yes. And what's the other ratio, Tanika?
The loan to value?
Yeah, the loan to value. Now, in your institution, loan to value means what?
Meaning pretty much the loan amount
Right?
over the appraised value.
Yeah, the loan amount over the appraised value. What is your policy requirement for loan to value?
We go up to 95%.
And in this case, it's only 83%.
Yes, correct.
Yeah, so you're under the requirement in this case and over the total debt service ratio requirement.
Correct.
I would say, all things being considered, book the loan. And what do I mean by all things considered? It is not a new client, I presume.
Well, yeah, well, all the clients that we deal with would be considered new clients.
Okay, but in that case, even though they're new clients, so to speak, in your case, the ratio, the debt service ratio is not significantly over the policy requirement, and the loan ratio is significantly below. They pretty much balance off. All things being equal, they meet the other basic requirements and prerequisites. Yeah, you do it. You don't let 2 percentage points with everything else in order cause you not to do it. By all means.
I agree.
Okay, by all means. I hope you did it.
Trying.
But go back and make an argument. 2% above policy is not significant or material, and also the loan ratio is way below the policy requirement. Yeah, go on. Yeah, make an argument.
I have a question in reference to that.
Okay, Erica.
As an auditor coming in, that means if that goes through, you're going against the policies and procedures of the actual institution. As an
Right.
auditor, that'll be something that that we'll raise.
Correct. And believe it or not, I don't know if I mentioned it, but I have an audit class that I'm currently teaching on Monday nights, and a similar question has come up. Does the auditor have any discretion? And the answer is yes. The auditor does have discretion in terms of when they see situations to determine if it's a material error, if it's a material problem, and to what extent it has to be before the auditor becomes concerned enough to report it. And so in this case, Erica, yeah, technically the auditor might come in and say, okay, who did this loan? It's 2% above the policy requirement. That's an auditor who's sticking to the policy, especially if it's an internal auditor. Okay, and maybe even write it up Okay, Tanika Johnson exceeded the policy limit by 2 stinking percentage, not stinking, you know what I mean? I'm just making it dramatic. 2 percentage points. All right. And then Tanika's gonna write back and say, yes, it is about 2 percentage points. However, I do have management approval to do this. And we all agree that 2 percentage points above with a loan ratio position that's significantly below policy balances this particular case and all other things being equal. And then the auditor might say, okay, fine, I'm just doing my job, watch yourself. And so, yeah, both of you have an equally strong argument from your different job perspectives, and that is really what we see on a day-to-day basis in terms of perspective with these things, right? And so again, depending on the situation, if the company is going to make money, you have to be practical, not weird, not ridiculous, not jumping over policy by significant amounts and percentages, but certainly where the amounts and percentages are small and immaterial, it's an opportunity for the company to raise revenue safely, so to speak, and therefore, yeah, the auditor will recognize it and maybe even make a note of it, but it shouldn't stop the management and the team from doing business with that kind of risk, because that's a fair risk. Okay. But the auditor has to do the auditor's job, and Tanika has to do her job. The whole idea is at the end of the day, you want to make sure that the company continues to operate within a safe environment, and in this case, that is a safe bet, so to speak. By all means. Now that's what I'm talking about, okay? Because those are the kinds of things that cases that you run in from time to time, and you have to decide how you're going to deal with them. And again, what is interesting is Tanika raises the matter from a management perspective, so to speak, and Erica is raising it from an internal audit perspective, and maybe even an external audit perspective. And both of those perspectives are absolutely necessary for the healthy management and running of the firm. And that's exactly how it should be, right? By all means. Good stuff. All right. There we go. I hope everybody in the room understands the loan ratio and the total debt service ratio. We talked about that in part 1. But of course, if you don't remember all the blah, 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 feel free to say, wait a minute, I don't remember that anymore. By all means. Okay. Good stuff, Tanika and Erica. That's exactly what I was looking for. And any week we roll in and you have anything of that nature, please raise it, because it might help you to get clarity and certainly be of some value to maybe your colleagues in the room. So I haven't sent you the case study yet, but I will. And when you get the case study, you'll see the instructions on how to proceed with the case study. The case study will be worth 10% of your grade. So I'm not necessarily looking for a university research paper. I'm just looking for your best effort and for you to do a little research and to put your thoughts down on paper. That's the whole idea. Credit people are oftentimes involved in writing stuff in one form or another, preparing reports for management, preparing reports maybe for a regulator, the Central Bank of Bahamas, whatever. So it's important to be able to research information and put your thoughts clearly on a piece of paper. And that's really my goal for my objective in having you do the research paper. Okay. The research paper will not be due until on or before the last class of the semester. You don't have to wait until the last class. Okay. Once you're done, you can pass it in. But make sure you wait a while to get some information to work with. You do not only have to work with your class notes. You can use all the open source information systems that we have out there, Google and others in particular, to help you to get information to prepare your paper. Okay. Any questions so far? Okay, fantastic. So now we can get into picking up where we were last week. Nigel, are you there? Does anybody remember the name of the movie theater that's on Thompson Boulevard?
R&D Plaza.
R&D. Thompson Boulevard? I mean, the one that's going for the airport.
Fusion.
Yeah, Fusion. I suspect Nigel must have signed in and gone to Fusion. What do you think? I don't know. We shall see. Okay. Does anybody remember where we left off last week? Let's see how closely you guys are following. We did some people did some reading. We were still finishing up chapter 1. Anybody remembers? Did we talk about the credit history? Like where did credit evolve from? Did we talk about that?
Where did we stop? Did we stop on page 1.6?
Okay, somebody says 1.6. Do we have a second or not? Well, remember we said that the whole issue of credit came about from way back when, from business started all over the world in particular places during the Civil War in the United States and other countries where we had the concept of credit evolving and that certain things happened to cause credit activities to expand. And we said that there were many reasons given for the development and this expansion of credit in general and merchandising credit. By the way, let's just get this out of the way again. Can somebody define merchandise credit? What is that? Merchandise credit. We know what buying credit is and all the types of loans that occur in banks and credit unions. But this new concept of credit has come up that we're talking about a lot in this semester to run parallel with banks and other types of credits. But what is merchandising credit, anyone?
It is granting credit from one company to the next company.
Yeah,
For goods and services.
absolutely. The granting of credit between companies and entities, typically wholesalers and retailers and people in such business. Absolutely. And of course, remember we said that this is a pretty much unregulated business, not only in the United States, but here in the Bahamas as well. We don't hassle retailers about meeting any regulatory requirements and KYC and all that stuff. And if you're lending money, you have to have a total debt service ratio and loan to value. No, we don't say that to merchandisers, as we do with the policy requirements for financial institutions. But it is no less credit in the millions and billions of dollars that occur worldwide on an annual basis. So it's a very important part of the business world, and certainly a very important part of the credit world that persons don't talk a lot about except if you're in merchandising credit. Buying credit and public credit and all the other credit people, they don't talk about merchandising credit and vice versa because everybody's caught up in their own credit world. But because everybody's caught up in their own credit world, let's not make a mistake in thinking that they're not all connected. Okay? They are. So this merchandising credit and credit in general evolved because of a couple of reasons we looked at last week. Is that more people came into the world, so therefore more people were consuming goods and services, and so like we say in the Bahamas, we have to borrow more. Okay, for sure. Technological developments, remember last week we said created the need for more credit, changing role of government involvement in credit. Let's not forget the socio and political changes in the society, the governments that cause the rules and regulations and practices of credit to change and evolve over the years. Also, the growth of the credit, the capital market. Anybody knows what the capital market is? Ever heard it?
Could I take a shot? Could it be like Forex and
Yeah, keep going.
more-
Keep shooting. You're on the right track.
Forex, commodities, futures market? I mean,
Absolutely. It's all about trading on the securities markets, whether it's Forex, which is foreign exchange, futures markets for commodities, whether it's stocks or bonds, whatever the trading that's going on in the local and international markets in those areas, that is referred to as the capital markets. Way to go. On it. And so the whole point is, as credit people, you're not just restricted to total debt service ratio and loan ratios. You also need to know, depending on what type of credit you're in or may end up being in, or even communicating with somebody who is in another world of credit that's different from yours. When the conversation come up, the more you understand about what's around you, even though you may not be dealing with it directly in your own job from day to day, the more effective you will be in your environments. Okay. And sometimes your environments, especially as time passes, as you get promoted and all this kind of stuff, those environments change. The company you keep changes and so on. And so the more informed you are about these things, the better equipped you will be to function. Really, that's the whole idea of looking at this thing in a big picture way, so that you get as much little bits and pieces like, hey, capital markets and credit, that's cool. But that's also an important part of the credit activity. As a matter of fact, whether you believe it or not, there are some people who actually borrow money in order to go into the capital markets to trade, hoping to be profitable and then pay off the loan if they are profitable. Of course, sometimes they're not profitable and have a big old loan to pay, and then that's another problem. It's called a delinquency problem. But the whole point is, all these things are interconnected. The growth of the capital markets. And then, of course, the other thing that was mentioned was that merchandise credit techniques improved. They found easier and faster ways to give credit to each other, easier and faster ways to root out the bad apples, those who don't like to pay on time or who don't want to pay at all. They have a way of getting the word around. And then when you go back to get credit, they will reject you because they don't have a credit bureau, but they have an informal system that if you mess up, word will get out there. You won't believe how fast, especially now, when you can get things out in the click of a button, send it to all attachments in a split second. And so the person then who doesn't pay suddenly is stuck and cannot get credit. Okay? Which is what the credit bureau will do to a lot of Bahamians in the future who have a whole lot of loans, some of which are not paid, some of which are delinquent, some of which might be worse, in worst case. And so now they go back to the bank in 2023 or 2024 to borrow money for school fees or something, or whatever the case might be. And the credit report is now sitting on somebody's desk. A dreaded credit report. And if it's not favorable, chances are, if not immediately, in a very short time, financial institutions will be turning clients away. Is that good for business for financial institutions? Not entirely, but somebody has decided that this bureau is going to be, or supposed to be, doing more good than harm. I suspect the time will tell whether it's doing more good than harm. Okay. Nobody's expressed any thoughts on the credit bureau, but if you think of anything you want to say about that, I love it, I hate it, I despise it, I'm enthralled by it. I'm confused by it, whatever the thoughts are, feel free to raise them. Okay, so basically, all of the, some nice exam questions right there. What are some of the reasons for the increase in development of credit? And then you have a whole list of them, more people, technology, socio-economic, and so on. I believe that's another hint, perhaps. I kind of drop hints along the way. You have to be present to pick them up. Okay, so society has basically expanded in all fashions and forms. As society expands, so does credit, and everybody's happy. You don't have to pay cash for everything. You can pay in little installments. Creditors are happy because now they can give you a loan of facility of some kind of credit facility and collect the money over time, and more importantly, collect interest. So they get to make money on the credit, whatever form of credit it might be. But remember, students, as I'm sure you know, credit is not free. Even if somebody tells you it's free, there's still an underlying cost somewhere. By all means. All right. So somebody said we're on page 1.6, and it appears that that person is correct. Who said that? 1.6.
I said that, but
Yeah.
I didn't say that for a reason.
Meaning?
You know what I mean?
Doggone it. But yes, it is. It is 1.6. And I think we kind of stopped right at this bloody journal transaction. Anyway, and so let's just go there and see. Remember, we were saying that whenever there's a transaction in merchandising credit, we have the creation of an accounts receivable and accounts payable. Does anybody know the difference between the two, an accounts receivable and accounts payable? Ever heard it before?
It's the funds that that a company has received, and accounts payable, it's something that is need to be paid by that same company, such as bills, like light bill, water bill, maintenance, that sort of stuff.
Yeah, and even the vendor will give you credit until you pay me in 30 days. That's a
Yeah.
payable too.
That's a payable.
Absolutely.
Yeah.
And what did you say? And the receivable was?
Like funds that I would have gotten from that merchant. The funds that I took in, but the funds for the sale of my goods.
Interesting.
Yeah.
Let's see. You're absolutely right on the payable one. You're somewhat right on the receivable one. Let me see if your colleagues will kick in and say she is right, except for what point, anyone? For the receivable. Well, first of all, as long as an account is classified as a receivable in accounting terms and in business terms, that means that you have not yet gotten the money. Okay? That's why I said you were half right. The accounts receivable means you have not yet gotten the money, and it means that you expect to get it at some time in the future. Now, once you are paid, then the accounts receivable goes away. You see, accounts receivable in business and merchandising credit means that somebody owes you money. So anywhere you go and you pick up a statement, you see accounts receivable, that is money owed to you or to some other company. Okay. Nice little thing to know. If you loan somebody your ASU draw to pay their mortgage and they promise to pay you back in 2 weeks so you can pay your mortgage, then you have an accounts receivable. They have an accounts receivable with you because now they owe you money. The question is, will they pay you? If they don't pay you, you will continue to have an accounts receivable because you'll continue expecting to be paid so that account can be brought to zero. But that will not be brought to zero until the person who borrowed money from you pays it back. And so if you are doing a business loan or a mortgage for somebody who has a small business or some entrepreneur, and so you trying to evaluate their financial position because they want a mortgage loan from you or consumer loan from you or whatever type of loan from you, but they are self-employed entrepreneur. They have their own business. So now, what is one of the things you should be looking at on that financial statement, which we'll be looking at later in the semester, because again, credit people without any form of knowledge about financial statements, that's a big issue. Because sooner or later, you're gonna have to evaluate some financial report somewhere for some type of loan, more than likely. Okay? And certainly, as a result of that, you want to at least be familiar with. You don't have to be an accountant, but you want to be familiar with some of the key issues. And accounts receivable is definitely one of them. So when you give a mortgage for 30 years, that means, by the way, the person who's giving the mortgage, what do they call it? Mortgager or mortgagee? Mortgage corp people? The person who's giving or institutions giving the loan, they call the mortgagor or mortgagee? Take a guess. Don't worry about being wrong. The devil with it. The entity giving the loan, are they the mortgagor or mortgagee? Okay, let me make it more interesting.
The mortgagor,
Mortgagor, why do you say that?
because payer and payee. I just think mortgagor, mortgagee.
That's cool. Hey, you cannot come, and in this case, you happen to be right. Okay, not that it always works out that way, but that's an interesting connection. Let's see what Google says about mortgagor. Somebody put that in Google, and let's see what Google has to say. This is for mortgage call people, or anybody that does a mortgage. Understand credit unions are even doing mortgages these days. Is that correct?
Yes, we started.
Wow. Man, you guys are in the big leagues. Once upon a time, you couldn't go to a credit union about a mortgage. There's no way they're gonna take that kind of money and put it into even their members over 20 or 30 years. Hell no. But the fact that they now have the ability to do it, see, the credit wherewithal is an indication of how far the credit union has come in the Bahamas. And not only how far, but we don't only have one credit union, we have numerous credit unions. Imagine that. In Little Bahamas, numerous credit unions doing all these amazing things for members. Wow. Okay, anybody found mortgagor? No? What does Google say? Anybody found it?
The mortgagor, the borrower in a mortgage.
The
Typically,
borrower?
yes.
Okay, the mortgagor is the borrower. Did it say
Mhm.
anything else?
One who borrows money from a lender in order to purchase a home or other piece of real estate.
Interesting. Interesting. So if that's the definition for mortgagor, what do you think is the meaning of mortgagee? Maybe you can type that in. Let's see what that says.
The mortgagee
Mm-hmm.
is an entity that lends money to the borrower for the purpose of purchasing real estate in a mortgage lending deal.
Indeed. So in the case of Mortgage Corporation, is the Mortgage Corporation of the Bahamas a mortgagor or mortgagee?
Mortgagee.
Of course. And for you mortgagees who are doing mortgages all the time, it is imperative that you know without a shadow of a doubt the difference between a mortgagor and a mortgagee. And not only Mortgage Corporation, any institution that gives mortgages anywhere must be clear on the differences between those two, because those two expressions come up a lot, especially in discussions with attorneys and maybe other credit entities. So it'd be nice to be comfortable with the meaning. And sometimes we mix it up. Sometimes people mix up mortgagor and mortgagee. They say the mortgagor is the person who lends the money, and mortgagee is the one who bought, but it's really the other way around, as we've seen. Okay? So those two words are very useful words and important words to know in the world of credit. Yeah, so the receivable is what you expect to be paid. The payable is what you expected to pay. Remember, the receivable remains on the accounting records until it's actually the cash is received, and the payable remains on the accounting records until the company pays its bills. Simple as that. Okay. So if I ask that in a test, please don't be stuck. That's really all it is in fact. Okay. Pretty not a difficult concept once you get it. And so if you look at this particular ledger, you'll see that, of course, the ledger has the date and the reference number for the transaction. We are told purchases were made. How much was spent for the purchases here? How much did this company spend for purchases on January the 2nd? On January
On
the 2nd.
January the 3rd.
Sorry, is it the 3rd? Yeah, January the 3rd. Thank you. How much was spent for purchases? They purchased merchandise.
$5,436.20.
Absolutely. Were there any credit payments on that day?
No.
No. And so at the end of January 3rd, the company had a balance outstanding of
$5,436.20.
absolutely. Absolutely. Now, when was the balance paid off? Which day was the balance paid off?
Is it February the 2nd?
Yeah, February the 2nd, the entire balance was paid off. And therefore, as at the end of that day, we have what? A zero balance in the account. See how simple that is? And that's pretty much what they do all the time. Now, in practice, as the company gets more sophisticated and does more business, you have more transactions, they'll go a little more messed up than this. But the principle never changes. Okay? That's the whole point. So what happened on March the 7th? Sorry, 6th. Or is that the 5th? March the 5th. What happened?
They purchased some more goods.
Yeah. They purchased some more goods, this time for how much?
$8,764.10.
Yes, indeed. Now, something interesting happened here that didn't happen earlier with regards to the payment.
Yes.
Yeah. And again, a lot of times people make mistakes in jobs that they do because they don't really understand what's going on. They've not been properly trained to understand what's going on. And so sometimes, even though the concept in itself may be simple, if you're not been trained or exposed to how it works and what to look for and what it means, then you can run into trouble if you have to deal with it. Okay? Now, what is different about the payments on April the 4th and May the 4th that's different from the payment on February the 2nd? Other than the amount.
They only paid half of the bill.
Yeah, in April, only half the bill was paid. And so at
Yes.
the end of April, there was a balance.
Once, yes.
Yeah, and then at the end of, on the 4th of May, they came back and paid the other
Paid
half.
the, yes.
Absolutely. Okay. So welcome to the real world of buying and selling. That's all it is. Now we have a lot of little bits and pieces in between, like credit notes and debit notes and all that crap. But you know, the accountants will deal with that. That's not the major problem. The important thing for credit people to know is to be able to look at a transaction report and have a basic understanding of what is going on in that transaction report. And oftentimes even to look at transaction report of clients who come to borrow money and be able to understand a little bit about what's on that document. That's why in this class, we talk a little bit more about financial statements. Does that mean you intended to be like an accountant? Hell no. It takes forever to learn all the accounting concepts you need to know to practice. But as a credit person, it never hurts to be able to read and understand a simple balance sheet or income statement. Cannot hurt at all. As it cannot hurt to be able to look at this particular payable and receivables ledger and understand what it's actually saying. So even though it may have been gray last week, it is no longer gray. Okay? And that's the whole idea. All right. Now, if we were to go down to 1.7, we see a little discussion about a promissory note versus the trade acceptance. Now, for your information, and this is what I like about the material in this context. The reason why promissory note comes up and trade acceptances come up, because one of them is a document that is used to close a particular loan arrangement for one type of financial entity, and then the other one is used in another type of credit environment. Does anybody know which one is for which? Those of you who have read ahead. Which of the two documents would normally occur in a bank or credit union? Which of the two would occur in a bank or credit union? Which of the two, promissory note or the trade acceptance?
Is it the promissory note?
It is the promissory note. And why do you say that?
Because that's where I guess the person promises to pay the bank back for the funds they got.
That is the document every single time, except for a mortgage. When you go into a financial institution, bank or credit union or insurance company, whoever's lending the money, be sure if it's not a mortgage, you'll be signing some kind of promissory note. Now, I don't know how many of you in here have borrowed at all in your life, and how many times. Some of you may not have ever borrowed yet, ever. I don't know. But if you go to borrow, you will sign a promissory note. And you will sign a promissory note saying, I promise to pay the financial institution this amount over this period of time at this rate of interest. And then you put your signature there. And the reason why you put your signature there is so that if you decide you won't pay that loan, the bank can then use that document to sue you to say that this is proof that you came and borrowed our money. That's what the promissory note is all about. So when you sign a promissory note, are you signing your life away? Sort of, but not entirely. You're just signing for what you're borrowing in that particular situation. Now, the trade acceptance, on the other hand, you will not see in a financial institution's credit department. You won't. You will see that more so in merchandising credit. You will see in your notes that for those of you who may not even have been familiar with a promissory note, I made it pretty clear that by the time you finish reading 1 and 2, sorry, not part 1, on that page, you know pretty well what a promissory note is, pretty much what I told you. Okay? The promise to pay at some time in the future. Okay? Now, the trade acceptance, on the other hand, I think maybe, can somebody read that, number 2, the trade acceptance? Because I think we need to focus on that for just a moment. It's not something we see every day. Can somebody read number 2 all the way down to the end? Anyone?
The trade acceptance is a draft drawn by the seller against the buyer for payment of a specific sum at a definite time and place. This becomes an effective credit instrument only when the buyer indicates willingness to pay by signing the face of the instrument. This signifies acceptance. The buyer also fills in the name and address of the bank.
Keep going.
The acceptance then becomes a written acknowledgement of the sale and a promise to pay at a definite time and place. At due date, the seller deposits the trade acceptance with the bank for collection. Use of the trade acceptance is limited to a few industries and most often to accommodate a customer whose credit rating is satisfactory, but whose operation requires more time than is required by normal credit terms. The holder of a promissory note or trade acceptance realizes other advantages as well. Either instrument can easily be turned into emergency cash by sale to a third party at a small discount, or by offering them as collateral, the instruments can be used to increase the bank borrowing ability of the holder. Further, in the event of the signer of the acceptance or note is either unwilling or unable to pay at due date, the holder can enforce payment through legal action.
Thank you very much, Erica. So those of you who are in credit, who are just doing your normal stuff, here is where credit is and seems very sophisticated. Not that you're not doing these things, but some of the stuff that she read brings home like, really? I never even knew there was something called a trade acceptance. I never knew that a trade acceptance is similar in context to a promissory note. I didn't really quite remember what the promissory note was, even though I give credit. But again, a lot of this has to do with actually where you work from day to day and how small or enlarged your quote unquote territory is in which you work. Which is why it's important to come out and do this crazy stuff called extra classes so you can enlarge your territory conceptually, get more information about what's going on in your environment and outside of your environment. Because if you guys who are on credit don't know it yet still, credit people are only best well-rounded when they are best informed about the things that are around them. And oftentimes those things are not directly related to credit. Okay? I'm sure perhaps some of you may, in dealing with a delinquent customer or giving a customer a mortgage loan or other type of loan, you may have to counsel some people on how to manage their money. You may have to deal with some marital issues with people who are fighting internally. and then they bring it to the office, and whatever the case might be, credit people need to be aware of so much more than just booking a loan or issuing a trade acceptance so that they can recover the payment. And the beauty with the trade acceptance is when the buyer signs it, the seller simply waits for the due date and he doesn't have to run the buyer down like we have to do in financial institutions. Typically, he takes the acceptance to the bank will process the payment. Now, the problem for the seller is when he takes the acceptance to the bank and the bank says NSF, then the seller has a problem. Does anybody know what that expression NSF means? NSF.
I think it's not sufficient funds.
Yeah, it means not sufficient funds. Now, the bankers in the room should be familiar with that expression. When does an NSF occur, you think, in a financial institution? When might that occur?
When they don't have the funds on their account and a check is presented for payment.
Yeah, if the check is presented or the trade acceptance document is presented, the money's not there, then it's NSF. You have to now go back to the person who signed the acceptance, who issued you the check, to try and get the money. Okay? And sometimes people issue checks and acceptances knowing that the money is not going to be there. Anybody knows anyone like that? They know there's no money, but they're still giving you the check to get rid of you and buy some time. For some people, they even leave the island.
Yeah, Bahamians do that all the time.
Yeah, we do that still.
All the time.
All right. A word to the wise is sufficient. Sometimes, for example, I do consulting work for small businesses, give them direction on some things they should do, how to manage their inventory, suggesting how they should go about preparing financials, and all these kinds of things. And so, of course, I don't do it free, I do it for a fee. And in the old days, when I used to do that, they would issue a check. Some of them knew that there was not going to be any money in the account, but they issued a check to make it seem as if the deal was complete. And of course, when I go back to the bank, the deposit goes through, the check is returned, or if I'm standing at the counter, I'm returned. Then we take it back to the drawer. I'm like, but they don't have enough money. The bank doesn't answer that. Just says take it back to the drawer. But we all know what that means. Okay? And so here I am now in the 21st century after so many years of doing this. If somebody's bold enough to give me a check, one of the things I do immediately is I don't deposit the check. I don't wait until the next day. I go directly to the bank with the great hope that what? Anybody knows? Why do I go directly to the bank with great hope?
Hoping the funds are there.
Yeah.
Check was clear.
Oh, yeah.
Yeah, clear.
Yeah. If somebody gives you a check, that doesn't mean you're paid. That just means you got a check.
But in these day and time, I mean, most people are now transferring the funds right away. Checks
I
are real,
know.
they're becoming obsolete. So someone give you a check, you tell them, no, you don't need to give me a check no more. Just transfer it to my account, bam.
I know, but some people don't have any transfer systems yet, especially small businesses.
Well,
So yeah, but yeah, if they can make the transfer, that would be great. And a lot of small businesses, for example, they hate that because they don't really want to pay you yet. They just want to give the appearance that they want to pay you. Just like with creditors, some people owe the bank money for loan payments, and sometimes they want to pay the loan when they feel like it, not on the due date. And for some people, that includes even their mortgages. They still don't understand that a mortgage is a major priority. You pay that first. And if you have to drink water, go to the pump on the side of the road, drink water. So you don't die, but pay the mortgage. Because if you don't pay, the BMC will what? PMC, do you guys foreclose on people's houses?
If you don't pay, you can't stay.
You don't pay, you can't stay. Yes. But just when I thought I've heard everything, something new comes up. I have to tuck that away. So if you don't pay, you can't stay. All right. So some very important credit issues. Promissory notes versus trade acceptances. As much as they appear different, they're very much the same. They have the same intention and they work pretty much the same way. Another form of payment is letter of credit. Anybody ever heard that one? What is a letter of credit? Any bankers in the room? What is a letter of credit? I just say that to be facetious because you're a banker doesn't mean you have a grasp on every bloody banking thing that's going on. Just like if you're a doctor, doesn't mean you know everything about medicine. You know everything about what you do. Same principle. If you're a general practitioner, you can't be pulling mold of anybody's skin. They might bleed to death. I'm a doctor, I'll pull it off. I don't think so. Okay. Anyone? What's a letter of credit? It's right there in your notes. 1.8. Tells you exactly what it is. This is an am I the only one saying this?
An instrument of finance initiated by a buyer through a bank promising to pay a designated sum of money under conditions agreed upon with the seller.
Indeed. So, like the trade acceptance, you agree to pay the person you bought the goods from, which is the seller, you're the buyer. And so you go into your bank and give the bank the details of the shipping arrangement. The seller is in Nassau, Bahamas, and the buyer is in Bangladesh. And so you have a currency issue and you have a time issue and a space issue and a cultural issue and a crookedness issue and all kinds of potential problems, especially when you're doing cross-border transactions. And so the letter of credit is very important for international transactions, so that the buyer and seller don't have to worry about trusting each other. The bank is the intermediary in the middle. And so once contact is made with the bank by the buyer and say, I owe this guy $2,000, the bank will hold the $2,000 from the buyer's account so that when the seller submits the letter of credit details, they say that the shipment is gone and has arrived to the buyer. Then once the bank verifies that this is so, the bank will release the funds. The buyer doesn't get to touch it. The seller doesn't get to touch it until it's time for him to receive it into his account. Who can argue with that arrangement? Anything other than that internationally is going to be a big problem potentially, because sooner or later, somebody's going to think they're smarter than the devil even and try to get away with something. Human nature eventually kicks in at some point for some people. Now, also in credit and specifically merchandising credit is another expression that regular financial people, lenders, credit union people don't hear all the time. It's called selling terms. And these selling terms pretty much define the credit terms of the seller will make available to the buyer, so that they both come to an arrangement on who will pay what and what under what conditions. And so these credit terms, speaking about credit terms and merchandising, can somebody say or give an example of a credit term in banks and credit union financial institutions? What would we consider the credit term? credit term?
Is it the length of the loan?
Yeah, the length of the loan is definitely a credit term. That may not be the only one, but that is a very important one. Okay. Can you think of one other thing that might be a credit term? In merchandising, we refer to as the conditions of payment arrangement. Same thing in financial institution. It's a condition of payments arrangement. How long the loan will run is a condition. What other condition you might get as a borrower from the lender, or in this case, the seller to the buyer? Other than how long the term the loan will run for, or the credit.
The interest rate on the loan.
Of course. What is the interest rate going to be? That is a very important term. And if you are a mortgage company, the other thing is on the credit terms is from a buyer and seller's perspective, will the interest rate be fixed or variable? Now, speaking about credit terms and interest rates, what do you think might be the better facility? A fixed rate interest or a variable rate interest?
Mr. Wilkinson, could I say, could it be as it relates to the risk of the loan?
Yes, you can bloody well say that. Absolutely. As a matter of fact, the fact that you say it relates to the risk kind of confirms in my mind, and that's what you call thinking outside of the box. But you could have just said one or the other, but you said, wait a minute, could it be a condition of risk? And the answer is yes. All right. As a matter of fact, if a lot of professional lenders and experienced lenders sometimes consider the risk aspect of things, there's certain things that they would not have done and would not do. So yes, risk is connected to that particular point, fixed or variable.
You're asking which rate would we prefer?
Which rate might be best?
Oh, well,
Or
it depends on, well, for me, if I could get an interest rate of like 2%, I would prefer a fixed interest rate.
Okay, as opposed to?
One that varies, because I know for us, we have 2% above prime.
Right.
So let's say prime goes to 5%, then we would have to increase to 7%.
Correct.
Where right now it's 6.25, so it just varies. But if you have a low interest rate, low in my opinion is like 4% and lower, then you should get a fixed interest rate.
If you can get one, absolutely. Because some lenders will not allow you to get one. For example, in the Bahamian economy, rates do not move too often, luckily, at least not mortgage rates. Okay. And so our prime rate tends to hang around at whatever number it is for long periods of time, unless the government central bank wants to create some kind of environment, either stimulus or de-stimulus. And so in the Bahamas, we don't have our prime rate moving too often. It can sit at the same for years. And then, of course, financial institutions will add a percentage. In her case, in this case, she said 2%. In that situation, when you get a fixed rate or variable rate in the Bahamas, it doesn't hurt you so much as if you get say a variable rate in the United States or the UK or Europe, where interest rates could also be low if you're in a place like the United States for long periods of time, or in other countries where they are unpredictable. So all of a sudden, if you cannot get a fixed rate loan mortgage, and a lot of lenders, depending on where you are in the world, they do not want to give you a fixed rate mortgage because they know what that means. That locks the institution in. And many lending institutions around the world do not want to be locked in on any interest rate. So they'll tell you variable or nothing because they want to be able to change the rate whenever the market changes, for better or for worse. Okay? Now, keep this in mind. Increasing interest rates, are they good for the customer or the lender? Increasing interest rates, are they better for the customer or the lender?
The lender.
The lender, of course. When interest rates go up, they collect more interest. Simple as that. When rates go up, it gives borrowers the horrors because now they have to pay more. And so buyer and seller, borrower and lender always seems to be on the opposite end of the stick. And that's the way it was designed. Okay? Good stuff. And these variables, these little bits and pieces are important for lenders to be at least aware of, for conversation, for change of jobs, for promotion, for sitting to the board and giving a report. See? It's important to be able to use and understand this language so that if you find yourself in a situation outside of your normal day-to-day, you can still function and function somewhat eloquently if necessary. That's the whole idea. So the terms of the sale is a very important part of the buy and seller arrangements. The terms are normally set by the seller. The buyer may or may not accept those terms, but the whole idea is they keep bargaining until they come to some agreement that is satisfactory to both. In the typical lending institution that we're familiar with, it doesn't quite happen that way between lender and borrower. The lender tells the borrower what the rates are, what the conditions are, what the terms are. If the borrower doesn't like it, he has to find another bank until the borrower can then find the conditions that are suitable to them. And depending on which country and jurisdiction you are in, you may not find it so easy to go to another bank because the next bank is pretty much the same, and the next one is pretty much the same, and so on. So it's a very interesting situation, these terms of sales, but you certainly do need to be aware of them for any number of reasons. Okay? All right. Any questions so far? Perfect. So if we go down to page 1.8 then, they give us all kinds of bits and pieces about selling terms on credit. And that these credit terms range anywhere from direct cash payments in advance to 6 months or more in credit. Why do you think some organizations request cash in advance? Anyone? Is cash in advance a credit facility? Anyone? Is paying cash in advance to the seller a credit facility? Yes or no? If you pay cash for something, is that a credit facility?
I'm gonna take a risk. In some point it is,
Uh,
could
If-
be.
if you can support it, how would you support it to be a credit facility?
Because some loans require you to pay a percentage before any other contractual agreement is arranged.
Okay,
Like you require to pay 5% on a mortgage before any paperwork or anything that is signed between the mortgager and the mortgagee.
Aha. That's what I'm talking about. She is kicking right in with that crap, and that's what you're supposed to do. So now, when you go to your next doggone staff meeting or some other meeting or some crap going on, or the doggone Christmas dinner or whatever, and something comes up, you say, excuse me. First of all, we need to be very careful how we consider the issues surrounding the mortgagor and mortgagee in this institution. And this is what happened to Chantel. And that's the whole idea. That's why you learn new stuff. So you can go out and say different things, understand different things. That's the whole point. Okay, way to go. All done it. But yeah, man, you guys are really out of the box tonight, considering after all day. Because see, not a lot of people would have thought like cash, but if cash is involved, then it's no credit transaction because it's cash. But that is not necessarily true. That is true most of the time, except for situations that Chantel mentioned. If you have to come up with a down payment, that's cash in advance. And yet, it is still a credit facility. Now, if you're paying for the whole thing in cash in advance, that is not a credit facility. But that was not what we were discussing. We're saying, how could you pay cash in advance and still have a credit facility? And she came up with a perfect answer. Okay. All right. None of this crap works. So, as credit people then, and you're reading through this stuff, some of the expressions you might see between the buyer and seller of merchandising credit, because you're not operating in that field, it's just like somebody working in one institution and not doing certain types of loans. They would not be familiar with the procedure for those types of loans. Their primary work is the granting of mortgages. The primary work is the granting of business or commercial loans, and therefore they don't have any experience whatsoever in the lending for consumer credit or mortgages or whatever the case may be. But again, the whole idea is, even though you may be working in specific areas, specific type of credit environments, it doesn't preclude you from understanding what's going on outside in the rest of the world from a credit or other perspective. That's really the point. Now, there's a little discussion on that same page. I hope you guys have read it. And it talks about some of the things that might influence credit terms. Okay. One of the things might be the time issue. The other thing might be competition, might influence the credit terms. And of course, the credit standing or credit rating of the customer might include the credit terms. Now, for those of you who do other types of mortgages, I hope you could see in those 3 points that I raised on that page, the equivalent from your side and the type of loans that you do. For example, if I were to say to anybody in this class, given the type of loans that you do, okay, which of these 3 things you think might influence your credit decision? 1, both, or all 3? Let's go to 2. Let me help you along. BMC, do you guys have any competitors in the mortgage market? No? BMC staff, do you have any competition in the mortgage market?
Yes, we do.
Yes, you do. What would you say might be a competition?
Commercial banks.
Yeah.
Now the credit union.
Then
Mhm.
now those credit union people, yeah,
Yes.
they are,
Yes.
yeah. And let's not forget whom else? The insurance
Companies, insurance companies.
by all means, by all means. And then we have some other unregistered companies giving loans. Is that true?
Most definitely.
Yeah, they're not banks, but they're giving loans like hell. Is that legal? Well, like we say in the Bahamas, we ain't know, because them is all kind of funny stuff. But yeah, we do have some financial institutions out there who are competing with all of you guys. And they're not banks, and they're not considered legally, from the government's perspective, financial institutions. Yet you can go in and buy property, you can go in and get a vacation loan, you can go in and borrow ASU money, even they say. I hope that's not true, but that's what they say. Okay. And so, what might influence the interest rates of the mortgage corporation? The interest rates that are being charged by the competition, true or false? True or false?
True.
Absolutely. If all the other lending institutions reduce their rate to 3%, BMC, and yours is 6.35 or whatever, are you gonna keep it at 6.5?
Nope.
Nope. You're gonna have to bring it on down. Otherwise, the people will move their facilities from where you are and go to the lenders with the lower interest rates. See? That's what we mean by competition can change your selling and marketing terms. Simple as that. No matter what kind of credit you do, competition gets in the way and makes everything stinky. But that's the nature of competition. Look at number 3. The credit standing of the customer can have an effect. Can influence credit terms. How? Can anybody see how?
The eligibility to qualify.
Yeah, the ability to qualify definitely will determine how the terms are going to go.
And this is where the credit bureau is really going to change the gamut of lending in the Bahamas.
Am I right? So a lot of people will not be going on vacation anymore, though. Well, question then. Since this credit union is here, they tell me. Will not credit union, credit bureau. Will credit unions benefit from credit bureaus in a real sense?
In what aspect are you asking that question?
From one trick question to the next trick question. Let's see. Let's make it interesting. In a typical lending institution, like maybe Scotia, Royal, BAF Financial, these people who lend money for whatever reason. When they call the credit bureau on a customer account and they find that the customer has several loans, one or two of them are in arrears and all this kind of stuff, that sophisticated lender from back in the day will look at that credit bureau report now and say, without a shadow of a doubt, perhaps, get thee behind me, Satan. Not Satan, you know what I mean. We can't do it. That's for the traditional financial institution. But let's go to the credit union. And they're a member, they go in. Because remember, a member to a credit union is not the same as a customer in some other financial institution. At least that's not what members feel. So the member goes in, the credit report is not good. What should the credit union do? Should they turn the member away?
They won't turn the member away. The reason being, because they are a member, they would feel more comfortable with that particular person, and the bank they wouldn't really have to answer to anyone else because the discretion is on them, what they can do and what they cannot do. And with them being a member, the member has a lot of say as to what they can get or what they cannot get, and they could probably plead their case better at a credit union compared to a bank. Because the bank have stringent rules and policies, I think the unions would have more flexibility. And so they'll be able to probably extend a bit more to their members because their members are buying into them.
No doubt about it. This is what makes credit unions so unique worldwide and in the Bahamas. And once upon a time, when credit unions were little itsy bitsy petty shops, people used to laugh at credit unions. But like David and Goliath, you were the little itsy bitsy credit union trying to compete with us. Now, it's a different story. Because now, where the member may not be able to get a loan as a traditional lender, they go to their credit union and say, I need $3,000. I don't care what my credit report says. I need it, and I need it now. Because my child's sick, and I don't want to burn down this credit union building or whatever. See my point? So yeah, it's all relative. That's the point I'm making. I think somebody made that point earlier about how things are relative in credit. And this is just one more example, how things in the marketplace, the competition, the nature of the client's credit standing, all these things. If it's a selling merchandising credit, what is the turnover of the purchaser? Are they turning the goods over quickly? If they're turning them over quickly, then the seller says, wait a minute, the goods are turning over quickly. That means that their cash, they have quite a bit of cash sitting down somewhere because they're selling stuff quickly. And if they're selling stuff quickly, they should have money to pay me back and so on. And if they have money to pay me back, then I have stuff to get them more credit. So all of these kinds of things will influence selling terms. See? How about that? Even in the oldest profession in the world, some sellers are on the corner, some sellers are in the hotel, some sellers are in the suite on the 59th floor, and each of them have conditions that will determine the terms and conditions that they give, or even the terms and conditions that the buyer will accept. Point is, selling terms are subject to all kinds of interesting variables, and they have to be carefully balanced if you're going to be successful. And competition, for example, is one of the major issues. This competition will swing things to hell, unless, of course, you're a credit union member. Then you don't have to worry so much about it. Which is probably why so many people are members of credit unions. In fact, a lot of people, if they were not members of credit unions, they would have drowned decades ago. Because the traditional financial institutions will not provide the same terms, typically in conditions that a credit union member might be able to get. If you have a mortgage at the credit union, you lose your job, they might say the traditional financial institution, after 3 months, you're foreclosing on that stinking house, even though they knew you lost your job or you were sick or whatever the case might be. But they tend to be a little more harsh. Credit union, maybe even the BMC to some extent, they said, you know what? This is our member. We cannot be seen to be putting our members out of their homes. That stinks. Word will get around and all hell will break loose. We'll give them enough time until they find another job. Then we'll restructure their mortgage so they can begin paying again, which of course is what most financial institutions should do under those conditions, except that many of them still don't do it. because they look like they're excited to kick people out of their bloody homes for some reason. Sending us a big time letter, but if you don't pay up in 90, 30 days, we're going and all that stuff. See? Terms and conditions. How about that? When I was a young lender at Bank of Nova Scotia, and customers run into trouble, they get sick and they cannot pay. They lost their job and they cannot pay. They've just gone through divorce and have to get themselves together before they can pay. Whatever it is. When those clients come in the front of me, my first inclination was never how I can get them out of their home, especially if it's a mortgage. Okay? And I was a youngster, didn't even have a mortgage yet. But the whole point is the last resort should be getting people out of their homes. I don't care what kind of lender you are. That was my position. And so when I would make proposals to go to the head office in Canada as to why we should refinance, restructure, give the people the time and circumstance and the terms that are required so that they don't lose their homes, they kept fighting with me. Oh, that's not the company's policy. Credit policy says after 90 days, go send the demand letter that the lawyers get rid of them or whatever and move on. So I always ended up fighting at head office until I developed a reputation for that guy in the Bahamas, keeps this and that. Terms and conditions, very serious part of the credit process. That's really what I'm trying to say. All right, I'm sure you guys are familiar with discounts. We all love discounts. Between buyers and sellers, they love discounts too. So whenever there's a cash discount for paying upfront and paying quickly and all that, and buyers and sellers take advantage of that. They save money. If the normal cost of the goods is $3,000, the seller might say, if you pay in cash, I'll take off $500. Imagine that. That would be great if you have the cash. Some people cannot take advantage of it because they don't have any money to take advantage of it. They need the credit term where they pay in 30 days or 60 days. And even then, in installments, not full upfront cash. Remember the ledger we saw? The second transaction was repaid in two parts for whatever reason, something happened. The first one was paid in full, great, they had money on the account. The second one, other things have to be dealt with, some crap went down, so they have to end up paying in two installments, which is fine. Who cares, so to speak, as long as you have a paying customer. Okay, for sure. So cash discounts. What about this expression, anticipation? Can somebody read that paragraph, anticipation? I've talked too much already. Anticipation, anyone?
Anticipation permitted in some industries is not shown as part of the selling terms, but rather as a notice elsewhere on the invoice. It permits the customer to deduct interest at a specific rate per annum for the number of days by which the customer prepays, anticipates the invoice. If the buyer receives an invoice bearing 70 days terms and pays in 40 days, the buyer has anticipated by 30 days and may deduct the interest charges for 30 days or 1/12 year.
Thank you very much. So again, this is not something you see every day unless you're in the credit, merchandising credit business. But as you can see, these guys have just like in other kinds of banking activity, they have all kinds of ways to encourage their customers to pay sooner, to pay on time, and all this kind of stuff. In this case, if you pay earlier, you prepay, that means you get to deduct some of the interest charge on that particular credit facility, which is really cool. Okay? If you're talking millions of dollars, it adds up to a lot of money. That's the whole point. What about a trade discount? What is that? Trade discount. There are other kinds of discounts which are not inducements for early payment. In other words, they don't necessarily encourage you to pay early, like a cash discount or even anticipation of prepayment. And these are referred to as trade discounts. In other words, if you buy in bulk, for example, then you might be able to get some money off. They encourage you to come back and buy some more stuff in great bulk. Okay, and so these are trade discounts that are taken off at the time you make your purchase if the purchases are significant. Okay? But that's about it for the trade discount. They don't have the same incentives and excitement as the prepaid or anticipations and cash discounts, for sure. So some examples of selling terms that you need to learn, because I will ask you to describe a couple of them. So when you get around to reading them and reviewing them, make sure you know, for example, what net 30 is. Okay. Notice in the merchandising credit world, net 30 and all these other selling terms are unique descriptions that they use and understand in the merchandising credit world. So if you get an invoice from a seller and it says net 30 as a buyer on your invoice, it means that payment of the full amount is due in 30 days from the invoice date. Not 30 days from when you feel like it. 30 days from the invoice date. So the invoice is dated the 30th of January, and the payment is due the 30th of, well, there's no 30th of February, or whatever day it is in February, whether it's a leap year or not, that day. Okay. Or if it's actually 30 clear days, then it may be March 1st or 2nd, depending on the situation. But that, for example, would be a case of net 30. What about net 60, anyone? What is that? Is it the same as net 30?
That's to be paid, the invoice has to be paid within 60 days,
60 days from?
the date of, from the payment, the due date.
And where would we normally find the due date?
On the invoice, right?
Absolutely, on the invoice. Okay, so now suddenly you work in credit at BMC, credit union, traditional bank, and then this plunges you into a whole other world of credit with a whole kind of different language. But even though it's not a language that you use in your credit work, it's a language that credit people should be aware of. That's the whole thing about this thing. Just like if you're a doctor, all right, if you have a practice, if you're a podiatrist, that doesn't mean you shouldn't listen to a conversation the ophthalmologist is having. You are not an ophthalmologist, but that doesn't preclude you from understanding the nature of these other things for one reason or another. Okay? Some of which you don't discover until it's time to discover it. One more, 210 net 30. What does that mean? 210 net 30. It's right there. Be bold.
a 2% cash discount in deductible if payment is made within 10 days from the invoice date. Full payment is due in 30 days from the invoice date.
Indeed. Is that a pretty good deal on the surface?
I guess, kind of.
Yeah, no, you're absolutely right. If you were a merchandising person doing credit, that's a pretty good deal. Okay, and again, it's designed to get the buyer to pay when, sooner or later,
Sooner.
of course. So it tells the buyer, if you pay within 10 days, I'll give you a 2% discount. Now, let me ask you something. Say 2% of $3,000, how much? Anyone? Oh yeah, you need a calculator for this class, by the way. Come to think of it. How about that? A calculator for credit collections. Two percent of 3,000 is how much? I know you have to go all the way back.
$60.
$60. So a 2% discount on a $3,000 deal may not seem like a big deal. Even though depending on who the buyer is, he might say 60 bucks, I'll take it. I'll save any money I could save. However, when we switch the scenario now and say, what is 2% of $3 million? Anybody? What's that? What is 2% of 3 million?
$60,000.
60,000. That's a hell of an incentive, especially if you have money to pay. Okay? And so those with money to pay can save a great deal of money, especially when it gets into the tens of thousands and billions of dollars in transactions. Okay? That's the beauty of this whole thing. Okay? And all these selling terms are out there for the benefit of both buyers and sellers. And the whole idea for them is to try to make sure that they meet somewhere in the middle, if possible, that one doesn't get an undue and unfair advantage on the other one. Sometimes it happens, but that's the plan. Okay. So please, when you look at these terms, make sure you don't have to know them verbatim, word for word, but you do want to have an idea of how they work. Okay. They're not difficult. You just need to actually look at them. All right. Then in merchandising credit, there's something called seasonal dating, which we are told add some extra time to the selling terms at certain periods during the year. So if you're in a seasonal business or seasonal terms and conditions are more suitable for you, some sellers will meet you there. So this merchandising credit world is very flexible, as you can see, far more flexible than banks and credit unions by every stretch of the imagination. Okay? For sure. Something to think about, especially those of us who are in traditional lending. Cash and checks, I don't think I need to try and have any long discussion about anybody in this class about cash and checks. If we're still trying to figure out the difference between those two, we have a problem, Houston. However, I would raise a question about the certified check. What is that? A certified check. Anyone? What's the certified? By the way, I've been hearing so much from Erica and Tanika and Juliet and Chantel. Where are the guys in this class tonight? Anybody knows? Enrique says he went out to pay somebody's bill, so he's excused, I think. But where are the other guys? Where's Philip? Philip, are you there? Man, I was here a long time ago. So Philip is off having a martini. Nigel is making sure that he doesn't have to contend with selling terms tonight. Well, I'm sure that Tanika and Juliet and Erica and Chantel can confirm that it is entirely their loss. So many interesting concepts went down. That somehow comes together in the long run. It's interesting how it works. So, the certified check then is a check that is stamped by the bank such that it cannot be returned. Once the bank certifies it, it puts aside or holds the amount of money that they've certified. And so the owner of the account does not get access to that money that represents the amount of the check. So that the presenter of the check is guaranteed payment. That's what we mean by certified check. And then finally, in this chapter, we have not just the selling terms between buyers and sellers, but also cash terms. Okay? And these cash terms are very simple to understand. You just need to have a look at them. Okay, net cash on arrival, very simple. And the goods come paid, no promises. Cash for the order, no credit. When you make the order, you pay then, because we're not even filling the order unless you pay. No credit there. Cash in advance, well, we know what that is, pay up front. We'll deliver the goods tomorrow or later today. What about this fourth one, cash before delivery? What is that? Cash before delivery? We prepare the shipment, but before we bring it to you, you have to pay. Okay. Cash on delivery, COD. I think we all know what COD is. COD, cash on delivery. When we bring our goods, pay. If we don't pay, we're leaving with our goods. We're not hearing anything. We're not giving credit. We're not taking promises. We're not succumbing to tears. Nothing. Tearing off your clothing in public. None of that stuff. When we come with the goods, you pay or we don't leave them with you. COD. Okay? For sure. Any other cash? What about consignment? Anybody knows what a consignment is? What is a consignment? Or maybe. See. Can somebody read that?
Consignment is like when the buyer received goods, but the title is withheld with the seller.
Yeah, simply put.
Like Sampin Motors, I could say.
Yeah, why would you use Sanford as an example?
Pardon?
Why would you use Sanford as an example? You're right. Why?
Because they get their cars from consignment, on consignments.
Yeah, in other
Within
words,
companies, yes.
yeah, the cars come here on consignment. Sanford Motors, along with whoever, in this case, the Kia dealer, I guess in Sanford's case, they make an arrangement where Kia United States maintains title to all the goods. And then Sanford, on the other hand, says, great, you can keep your old stinky title. I'll inventory the goods here and make sure they're secure. And I will make sure that they get sold. And on every sale that I make, I expect to get X amount in commissions. Okay. And yes, that is how goods on consignment will work. if at the end of the day, any goods that are not sold, typically the agreement is that the consignment of goods can be returned to its rightful owner, hopefully unblemished. Because if you have something broken or stolen, you would certainly have to repay the person who owns those goods. So yeah, welcome to another world of credit, where actual credit, as we know it, does not occur, but credit in the world and in concept does occur. So the consignment is sometimes seen by some people as a form of credit, even though in fact and in principle it is not. All right, so that pretty much ends our discussion on chapter 1, which has been quite an involved chapter, but it involved a whole lot of interesting information that somewhere along the line will be of some value, no doubt about it, because a lot of it is credit related, a lot of directly, a lot of it is not directly related to credit, but everything is indirectly related to credit anyway, in one form or another. Okay. When I tell students that divorces have credit implication, like what does a divorce have to do with credit? Simple. Anybody knows? What does a divorce have to do with credit? Or your credit facility, or your ability to get credit? Anybody knows?
It could affect the life of the mortgage.
In what way?
Saying that the two parties, they get a divorce, they want to split the home or they want to split up the assets 50-50. It has to go through all kinds of legal formalities and that could literally cause the loan to go into arrest or delinquency.
Also, the ability to pay after divorce, the husband may have been paying, and then he may decide not to pay anymore because he's not with the woman, and so
Yeah.
no one may pay it,
Yeah.
and so,
She
like
says,
that's another problem.
absolutely, he might decide to stop paying, and she
And
may decide I'm not paying, or I cannot pay. Go ahead. Mhm.
And a lot of times, somebody has to pay the other one out. So that increases the loan amount.
Yep. Not only that, not only does it increase the loan amount, but it puts the loan in jeopardy in one form or another, because the payout occurs and the new person who pays out the other one wants to continue making the payment. They discover that they don't have the ability to make the payment. They don't have the interest to make it anymore. They're upset being divorced to begin with. They're not paying anymore. Whatever the reasons are, it's something like divorce does impact credit. And credit,
does.
yeah, definitely. Credit officers spend a lot of time with people who are going through divorce, watching the whole thing collapse right in front of your very eyes. Okay. So yeah, don't presume I work in the credit world, I'm insulated from all the other problems of the world. You are not. All the problems of the world have an impact on credit people in one form or another, if not sooner, later. If not later, eventually. If not eventually, for sure. How about that? So you're never really free. You're like police. You're never off. Something is always going on that will impact the credit world in one form or another. All right. So having dissected chapter 1 and really dragging ourselves into this very important stuff, we can now go through module number 2, which is a whole different world of credit. But remember, when I say a whole different world, I'm only talking in terms of discussion points, because remember also, all of these things are interconnected. Okay, for sure. Okay. So now our discussion swirls around how do we organize the typical credit department? I would like to say that I'm pretty certain that you guys already have your credit structure in place. But for the record, anybody from BMC, what is the typical structure of the credit department of the BMC? Like, who's at the top?
Wait, repeat the question, please.
In terms of the credit department at the BMC, who sits at the top of the credit department? Who's overall in charge of credit? What do you call that person?
The managing director.
The managing director. They make decisions, the final decision on all credits?
Yes.
My. Pretty tight control. Okay. So the managing director is the ultimate person to sign off on all credits. Okay. And then who sits under the managing director in the credit department?
The manager of credit.
The senior
Manager
credit
of credit.
manager.
Yeah, senior manager of credit.
Senior credit manager.
Yeah, followed by the
Credit manager.
credit manager, followed by the
Credit
Credit
officer.
officer.
credit officer, indeed, followed by the
Ambassador, pretty much.
Ambassador.
software ambassador. What does the ambassador do?
They're the ones who take the documentation from the clients and assess them to see how much they can qualify for.
Oh, very interesting. The ambassadors. I suspect you call them ambassadors because
They're the ones who actually greet the clients when they come walk through the door or via phone or email.
indeed, as do ambassadors around the world do. They represent the governments of their country and they spend a whole lot of time eating, drinking, and shaking hands and lying on behalf of their governments. How about that? That's why a lot of people fight to get ambassador positions because depending on where you are in the world, it's a very cozy job. And depending on where you are in the world, it's a very dangerous job. Who would want to be an ambassador to North Korea if it was possible? Anyone in this class? Ambassador to North Korea. Would anybody in this class like to be that?
No,
No.
sir.
Why not? Prestigious job. Big money. Why wouldn't you want to do it?
Crazy dictator.
Yeah, crazy dictator. Okay. The little fat guy is still on the rampage. Nobody knows when he's going to press the button. Okay. So you have a couple of crazy guys running around in the 21st century. North Korea. Putin. A couple, one or two in Africa, one or two in India, a couple running around the Eastern continent as usual. Okay. But yes, you're absolutely right. Okay. So who is going to introduce? I need somebody to read the introduction and some other information before we close our discussion in module 2, because next week we'll be picking it up to its conclusion and then moving into module 3. So I need somebody to open up module 2 for us today. Sorry, ladies, the fellas are not in the room. So that means one of you wonderful ladies have to pinch hit again for the absence of men. Well done.
I'll go ahead.
Okay, sounds good, sounds good.
Turn it down.
Let
That's
it rip.
Chapter 2, Introduction. Since particularly all sales between companies are transacted on a credit basis, one of the main functions of management is the effective control of the credit it grants. The credit department performs this function. It gathers and analyzes credit information on customers and determines how much credit will be extended and on what terms. The credit department is also responsible for collection of accounts receivable from customers when these are not paid in accordance with terms. The credit department provides a number of services, but its basic function is to protect the capital that is invested in the firm's accounts receivable.
Before you go on, Chantel, I'm not sure if you realize the full impact of what you read, but
Yeah.
certainly that paragraph packs the power punch or punches for any credit department anywhere in the world in any capacity, whether it's financial credit, mortgages, merchandising credit, public credit, private credit, whatever credit it is, that paragraph packs it. The job of credit is to protect the capital. In other words, if you work for a bank and you give loans, you have to make sure that you collect, that you're lending people's deposits, in case you didn't know. So you have to make sure you do everything to collect those monies that are outstanding because they represent people's deposits. If you work for a mortgage corporation, remember the money that is being used is the tax dollars, which means that now becomes the capital that we're talking about in that paragraph. And your job when you lend the money out to people for 20, 30 mortgage, 30-year mortgage, you have to be satisfied to the greatest possible extent that they meet the fundamental qualifications for that mortgage. Because if not, the capital will be destroyed, lost. And then tax dollars go down the drain. Depositors' dollars go down the drain. If it's a credit union, the member deposits go down the drain and losses because of poor credit decisions. Okay, Chantel, you've opened up a can of worms. Let's go.
Organization of the credit department. Before outlining procedures followed by credit management, let us try to describe the organization of a credit department. This will be general, not specific. A description, not a description, not a prescription. In all phases of business management, the objectives are clear: maximum sales and profits, minimum production costs per unit, tightly controlled overhead, and maximum use of all of invested capital.
In other words, no matter what type of credit you're doing, if it's a merchandising business, you want to maximize your sales and profits. If it's a bank, credit union, or a mortgage company, you still want to maximize your sales and profits. We're just not thinking about the sale of goods and services. We're thinking about the sale of loans and mortgages that we're given. See? And we want to maximize the return that we can get on those loans and mortgages by charging the appropriate interest rate and making sure that the loans are repaid. So again, the principle is the very same, no matter what type of credit or credit language we are using. Okay. All right, keep going, Chantel.
There are variations in the ways in which individual firms organize their approaches to these goals. So there are differences in the organizations of credit departments. There exists no uniform system. It depends on the size and needs of the enterprise. One concerns credit department is another concerns owner or office manager. In a small business, the proprietor or manager usually approves or rejects the credit and collects the slow accounts. As the business enlarges, this function is usually taken over by the office manager. When the operation expands so that the credit function requires the exclusive services of one person, this employee is the credit manager. If the company is still bigger, several people may be employed to assist its credit determinations, investigations, analysis, and collections.
Yep, that's where you guys are big. Okay, keep going.
As the extreme end of the corporate spectrum, the credit manager might be in charge of hundreds of people devoting their full time to the credit work. In such an organization, the credit manager is more an administrator, although no less a credit person. The work of the credit department is, in such cases, is divided among a number of job classifications from clerical to executive levels. But the duties performed and the job titles vary from company to company. The duties too are assigned differently in different concerns. Information gathering analysts, credit granting, and collections may be handled separately, each by a different individual or group. In other concerns, people will handle combinations or all of these duties. In comparing two organizations doing the same annual volume, we may find one credit department much larger than the other. A closer look will show that the company with the larger credit department has more credit details to handle for its sales users. Sales an item bought in large quantities by large industrial users. There are usually equally valid reasons for different approaches to the organization of a credit department, for conformity is not nearly so important as effectiveness.
Keep going.
Lines of authority. Like all department heads, credit managers are responsible for successful operation of their units. They design or approve the policy used in making credit decisions. They establish the procedures and means of gathering and analyzing credit information, setting credit limits on customers, and collecting delinquent accounts. To outline the way these tasks should be performed, they might prepare job manuals or descriptions. The typical credit manager is an experienced analyst and thoroughly understands each job in the department, probably from a background which included time spent at each of these jobs. The credit manager should personally handle the major customers, large borderline cases, marginal accounts, and all important problems and special situations. Credit managers have the final responsibility for all phases of credit department operation to perform properly. They should know the industry and its problems and know accounting and economics. They set the tone and style of the department and the attitude with which members perform their jobs. The responsibilities of a credit managers are clear. So too should be their authority, full autonomy to carry out all activities of the department in the best interest of the company. As department heads, they consult frequently with other members of management. In large organizations, the credit manager is probably an officer, maybe a director, is definitely a member of the management team, and usually reports to the company president or the executive officer in charge of finances.
Thank you so much, Chantel, for that introduction to the structure of the credit department. And of course, we have gone from the very simple to the very sophisticated kind of environment. And you guys can very easily determine where you fit in there, because everybody in this class fits somewhere in that spectrum. Some of the names are similar, some of the names might be slightly different in the positions, but certainly the principle is the same in terms of how we structure the credit department, who should be responsible for what. The big job of the credit manager or managing director, usually the senior credit manager or credit manager would have, not negating responsibilities down the line for the persons who are responsible for gathering information and recommendation. So you can see The credit function is one big circle of everybody in between, interdependent on each other to make the system and the program work according to the requirements. Okay, and so when we get back next week, we'll talk more about the division of duties and other things that typically occurs within a credit department, no matter what type of credit is being issued. And of course, the whole idea is for you to look at this and see how it compares with the structure of your organization, and maybe even decide, wait a minute, could we possibly make a couple of changes based on some of this information? You never know. And so we'll look at those things and see how the typical credit environment should look, should feel, and should function. All right, fantastic. Any questions before we break? Wonderful. You guys know how to find me if you think of something, if you need to reach me on any issue whatsoever. Do not be bashful. Please feel free to touch base, and I will be happy to answer any questions or issues along the way for you.
Mr. Wilkinson, I have a
Hi.
question. I have a
Mhm.
question.
Yes.
When a home is repossessed, isn't it a liability to that company, to the organization?
You
To
mean,
have, yeah, when a home is repossessed?
you mean the lender?
Yes.
Um,
Isn't it a liability, more or less?
that's an interesting question, Chantel. First of all, what in the world made you even think of that big time question at this hour of the night? It just No,
Sorry,
it's-
it just popped in my head. It just-
yeah, no, that's the thing. When you start learning, stuff crop pops in your head out of nowhere, like, where did that come from? It came because you are opening your mind by getting more and more information. Saying that's how weird and incredible learning is. So, to answer your question, is it a liability for the lender?
Yes, sir. Is it a liability?
Now, here's what's interesting. From an accounting perspective, Chantel and others, it is not a liability from an accounting perspective, because a liability from an accounting perspective is money that is owed by the company. But when you use the word liability, I don't think you meant that kind of liability. I think what you really meant is whenever a home goes into foreclosure, then the lender loses all that potential interest that it was hoping to earn. Correct?
Yes, but I mean, it's just sitting there. The home is just sitting there.
Well-
Nobody, yeah.
Well, yeah, because one, the home is just sitting there, and no payments are coming in. So the interest that you were hoping to earn month over month is not coming in. Secondly, the longer the home sits there, the more deterioration.
Loses value.
Yeah, and as it loses value, it makes it more and more difficult for you to get the market price that you may have hoped to get in order to pay off that facility. So yeah, in those cases, it is a liability to have it sitting, which is why prudent lenders, smart lenders, do one of two things, typically, especially with mortgages. It could happen with other types of loans, but especially with mortgages. Depending on what type of lend, in the case of BMC, which is a government entity, they're almost like a credit union where people who come in, it's a government thing. You want to hit people over the head like the private sector and cause them to bleed too much. So what do you want to do? You don't want to get into selling people's homes just like credit unions. They don't want to sell their members' homes. That's a no-no if possible. So what you try to do, restructure the loan as quickly as possible to get the customer paying as quickly as possible once again. That's always the ideal situation. You don't take the approach like private sector lenders, like, we're not going to refinance anything. They've given them all the breaks they can get, that we're going to get. We're going to sell that flipping house. No, BMCs and credit unions don't typically think that way because of the nature of their clientele. You want to find a way to get your client mortgage or loan restructured and as quickly as possible so that they can be in a position to repay once again. That's always the ideal situation for BMCs and credit unions. If a BMC or credit union has a house sitting for some reason for sale, that they're really trying to sell it, that is usually an exception and some tragedy has occurred, typically, okay, for sure. And so ultimately, they're stuck with a deteriorating asset. They have to sell it for whatever they can sell it for and then pay off whatever they can pay and decide if there's a balance, what to do about it because of the very nature of the clientele. But that's not typically what you ever want to see. And if you see it, you don't want to see it too often. You want to be able to say to your customer, now that you were sick, now that you're well, we'll restructure whatever the hell it is, start again. Credit unions and BMCs. You got divorced, you're now remarried, you're now single, but you're making enough money, family members are going to help you, whatever the case might be, fine. We're going to restructure it so that you can be whole again. And so that's typically what that kind of lender would do. So yeah, it is a liability if you find yourself with a deteriorating asset waiting to sell. And it is a liability because it has some degree, if you're a BMC or credit union, it has some reputational damage involved because now you have a certain clientele and memberships getting upset because the news is going to get out that you have their house sitting waiting to get it sold, and then it gets stinky, even though you may be justified in doing so. So yes, Chantel, in that sense, it is indeed a liability. It is your worst nightmare. Okay, for sure.
Thank you, sir. Thank you.
You're quite welcome. Hopefully you don't see too many of those cases. And now and then you will, but not too many, hopefully. All right, good questions, Chantel. Any other questions before we break? No problem. We still have a whole lot of weeks left for stuff to pop into your head like Chantel. And she came out with a great big fat rabbit this time because that question is so crucial to many organizations' reputation and the careers even of certain lenders, depending on how bad it goes. Okay, so that is a very, very good question. All right, so you guys take care. Please go ahead and read ahead. Read module 2 for next week's class. And if you feel froggy, you can't sleep at night, start reading module 3. All right, and we'll pick it up again next week. Okay?
Good night.
Good night.
Night.
Good night.